Will the market go up or down? Should you lock in or float? Find out this and more with Master of the Markets, hosted by Barry Habib of MBS Highway. Brought to you by United Wholesale Mortgage.
Does your wholesale lender do this for you? Free customizable marketing materials, online loan tracking for your clients, returns your past clients to you, and complimentary client retention campaigns. Don't you think it's about time you found one that does? Partner with United Wholesale Mortgage and receive these benefits and more.
Welcome to Master of the Markets. I'm Barry Habib at MBS Highway. This is created exclusively for Mortgage News Network. You know, the housing market has done really well. We got some great reports. Last week, we're going to see some important reports this week. I want to talk to you a little bit about breaking this down and seeing what this means. Look, CoreLogic told us just last week that the numbers on troubled mortgages, meaning those mortgages that are delinquent or those that are seriously delinquent, have really dropped off to very low levels, the lowest levels we've seen in a very long time. So this is good news because it takes that inventory, that's troubled inventory, off the market, and it shows that individuals are making their payments in a timely manner, that home prices are not going to be distressed, that there's a lot of support for them. This is the magic elixir of home appreciation. And we sure have seen a lot of that over the past 3 and 4 years since the bottom of the market. Now, I know the media still likes to kind of poo-poo what's going on in real estate, has been very anti-real estate, but it's a good thing we've been able to deliver a good message and explain to consumers that housing has been and will continue to be a great investment, and those that listen to you have benefited certainly. Now, when we take a look at some of the numbers that we received last week, especially on the new construction side, building permits looking like they're moving up higher, housing starts looking like they're moving up higher, in fact, the best numbers in 10 years. And when we look at builder sentiment, this is kind of a finger on the pulse reading. It was exceptionally high, highest number in a decade for builder sentiment. And this is telling us that there's good traffic, there's good optimism, and buyers are out there and should be very supportive of home prices. Inventory continues to be low, and we're also getting a lot of readings on forecasts for the years ahead. And they tend to be in that 6% range. Now, of course, real estate is local, and certain areas will have higher or lower appreciation, but we give you kind of a national feel to give you an average. And if you're looking at a 6% average, then let's knock that down a little bit and see what would 5% appreciation be on a home. So I think this is kind of important. We take a look at the median home price today at $228,000, and we say, okay, what would happen if we would continue to see 5% appreciation? Again, this is lower than the 6% that's being forecast, but if that were to happen in 1 year, that home would be worth $240,000. In 2 years, $252,000, 3 years, $264,000. And after 4 years, about $278,000 is what the value of that home would be. That creates a lot of net worth for that buyer. And certainly had they had decided to rent, listen to the media, they would have missed out on about $49,000, $48,000 of value in this great investment that they could have had in real estate. Now, how about the investment itself? Well, let's assume for a minute that if they put a 10% down payment on that home, then at the start, right at closing, they're going to be down about $6,000 when you consider their closing cost expense. So you sign up at closing, you're already losing money on your purchase. But over time, with a modest 5% appreciation, and by the way, this $6,000, this is something that we're looking at, which it does not include escrows or prepaids, since those are either deposits or monies paid in advance. So this is just a reasonable estimate here. But you're down $6,000. But after 1 year, not only did you recover the $6,000, but in aggregate, you're up $5,000. In 2 years, up $17,000, 3 years, $30,000, and after 4 years, even inclusive of closing costs, you're ahead of the game by $43,000. And what's that percentage rate of return? This is an interesting one because people are looking at what rate of return do I get in my investment? Well, on that 5% rate of appreciation, once again, with a 10% down payment, you start off underwater because of your closing costs. So you've already lost 26% on your investment at the day of closing. But believe it or not, after 1 year, you've regained that and you're up 23% in the first year. That's pretty darn good. After 2 years, 76%. 3 years, 131. And after just 4 years, you're up 189% on your investment. Now, where have you been able to get that? Another thing that we saw this week was we got readings on inflation. And the Fed monitors these pretty closely, and inflation is starting to tick higher. Now, this is going to be very counterintuitive, but we need a Fed rate hike to keep rates low. And we've talked about this in the past because inflation is the enemy of bonds, and as inflation increases, you have to counterbalance that with a higher yield, a higher rate of return to handle the increase in inflation. And inflation, although slowly, has been ticking higher. Fed telling us in testimony last week they want to be confident that inflation is moving towards 2%. Well, one of the important readings is Consumer Price Index, or CPI. Let's take a look and see what CPI did just last week. We see that when we look at the index, we take a look at the core, which strips out food and energy, so you get a real reading that's not involving things like pipeline disruptions or bad weather. And the way that it's figured is you have the most recent 12 months. So it takes into account the numbers from 2014 and the recent ones for 2015. Now, when May's number came in and was reported, May replaced the number from 2014, and that gave us an inflation reading of 1.7%. But now we replaced the number for June, that's just this past Friday, June of 2014, and we've replaced it with June of 2015's number. And June of 2014, to bring it back, was just 0.1%. The June of 2015 number came in, and it was 0.2%. So obviously, the inflation rate, that rose from 1.7 to 1.8%, moving closer to that 2% from the Fed. But we think that it's going to start to move much more rapidly, because look at what's going to be replaced. Next month, it will replace a very weak number for July, a low number at 0 for August, and a very weak number for September. So in the next few months, as these numbers get replaced, look what happens to the rate of inflation year over year, 2.2%. That means by September, the Fed could be looking at hiking rates. And if they do that, believe it or not, the bond market will rally. But here's the key. If the Fed doesn't have the guts or the backbone to hike rates, and if we see inflation moving up, you can expect higher interest rates. So this could be a very opportune time to take action. I know rates have gone up. Look at adjustables as an option, but this could be a very opportune time to take action. Talk to you soon. Bye-bye.
Today's Master of the Markets was brought to you by United Wholesale Mortgage.
This is Mortgage News Network.